My name's Dave McCary with McCary Wealth Management. I'll be doing a series of webinars in the weeks and months ahead that will focus on different case studies that help explain what I do for my clients in my wealth management practice. But I'd like to start by giving you a little background on who I am and what sets me apart from other advisors in the wealth management industry. I was born, fortunately or unfortunately, depending how you look at it, into a family of some wealth. My great-great-grandfather was Eberhard Anheuser, founder of Anheuser-Busch, which is the beer company in St. Louis. And because of that, I've spent a good part of my adult life actually managing my family's wealth for the last 20 years or so and helping my family craft a multi-generational wealth transfer estate. The lessons I've learned over the last 20 years have been significant. And it's those lessons, those high points, those low points and struggles that I can share with my clients and often help them avoid a number of the potholes that I've experienced with my family. The areas that my wealth management firm works in are 5: estate planning, retirement planning, insurance review, investment review, and tax planning. And over the next few weeks and months, I'll be doing case studies in each of those areas. So in this case study, I'll be looking at how my wealth management practice helps improve a client's investments in their investment portfolios. So asset allocation is important. And then once you've figured out the allocation into stocks, bonds, cash, that properly sizes to the client's overall financial goals and objectives, we then turn to the stock portfolio and specifically what investments the client is invested in the stock portion of their portfolio. And for this, I use a tool that does a deep dive into each of the investment funds that my clients invest in. This case study will show you a portfolio that came into my practice from a new client, and I'll compare that portfolio's investments that came in and then how I was able to improve on that client's portfolio. So first, let's look at the scoring system that I use when I'm diagnosing anybody's investment portfolio. There are 11 criteria in this particular tool. This is not the only way I diagnose and assess an investment portfolio, but it's one of the major tools that I use. There's 11 different criteria that this tool will assess each investment on. And those criteria include the inception date of the fund, and the fund needs to have at least a 3-year track record. The manager tenure, the specific individual managing that fund with at least a 2-year track record, what the size of the fund is, and the composition, and the style. There's a thing called style drift, where when you invest in a fund that it has a specific style, you really want to monitor it for staying within that style. If it veers out of that style, that can bump into some of your other funds that you've invested in your portfolio. So style drift is not a good thing. And then we look at the actual expense ratio, which is always important. We look at the alpha, which is what kind of a return above the market average can this fund consistently generate. We look at the Sharpe ratio. That's a risk-adjusted return. And then actual returns for the 1, 3, and 5-year period. So the tool assesses each fund on all of those criteria and then puts the fund into one of 4 quadrants and gives the fund a score from 0, which is the best, to 100, which is the worst. So the best first quartile would be scores of 0 to 24. The second quartile, 25 to 49. Third quartile would be 50 to 74, and so on. So let's go and look at a portfolio, actual portfolio from a new client that came in to our practice. That portfolio had 6 different funds that it was invested in. And you can see 2 of the funds were in the second quartile, below the yellow line. None of the funds were in the first quartile, which would have been below the green line. So there's the x-axis is that score from 0 to 100. The y-axis is a 3-year rolling average of that score. So the score is tracked over time as well as a point in time. This portfolio, 3 of its investments were in the third quartile, and one of them was in the worst, 4th quartile. So I did a lot of research and figured out what the new client would really be best suited to be invested in, and this is what I came up with. So this client went into 10 different, well-diversified, low-cost funds and ETFs, and the bulk of them, all but 2, were in the first quartile, and 2 were just outside and comfortably in the second quartile. So we really enhanced this client's the quality of their investments. Let's go back and review that. This is the portfolio as it came into our practice. And this is the portfolio after I improved on it. I hope you enjoyed this case study, and I look forward to seeing you again in the future. I hope you enjoy these videos, and if you have questions, you can always contact me by going to my website. Simply Google Anheuser Advisor. That's ANHEUSER. Thanks for your time.